Thanks, Dale. I've been doing this for about 15 years, literally thousands of businesses. At any given time, we're managing probably about 200 businesses for sale, very, very high successful rate. And biggest problem with selling businesses is getting a valuation right. So any opportunity that I have to talk to people like yourselves, I prefer to talk about valuation, because if you understand how to value the business and where the value of your business comes from, it will make it very, it will become very useful on the exit, but also during the building your business, so you don't overcapitalize in some issues, spend the money where you shouldn't, because some things do count, some things don't. So I've got a little presentation that I'm gonna share now with you. So I'm gonna talk about selling businesses from pretty much dollar to about $20 million. The reason why we stop on $20 million is if you got a business that's worth more than $20 million, it becomes an investment banking job. And the difference to what we do in investment bankers do, investment bankers got access to money, so they will find the buyer, but they will provide the finance. We do have a partners that can provide the finance, but we don't provide the finance. So, but we do negotiate a deal and help with that. So I already mentioned this. Understanding business valuation will help you make a better decisions through selling process. And often people, overexpand, make a business too dependent on them because it's profitable, but it does affect the value. And one of the biggest errors that people do is overcapitalize them. By the end of this presentation, you'll learn how not to do that. These are the three main reasons for pricing business accurately. Number one reason for businesses not selling, or not selling at all, for prolonged selling, or for less than selling for less than market value, is because they are overpriced. And there is the business process may going to take something like 6 to 9 months. In fact, it takes about 200 days to get a business from the beginning to the end. But if the business is not priced, it can turn into years. If it's not priced well, it can turn into years of selling. And through that process, what happens when you're selling a business for too long, you're not investing in money, you're not running a business as you're going to run. So businesses often decline. And I'll get into a few other reasons why that's dangerous. Now, these are, I went too far. Okay. These are the main reasons for overpricing: sellers' expectations. So what people do, they build into their pricing model 30 or 40 years of their blood, sweat, and tears into the business. And so you invest there. And I remember once we valued the business for somebody, and it was a very small business, and she said, let me just pull up. She was in the car when we were talking, and she said, so you're telling me that my business, 15 years of my life, worth only this? We didn't say that. We said that the business is worth whatever we said, but people price their time that they spend in building a business. Overcapitalization, it's a big issue. So let me illustrate this. Let's say you have I'll use a coffee shop example, but in manufacturing and transport and some other businesses, that's way more pronounced. But the reason why I'm using a coffee shop, because everybody knows what a coffee shop is and how the coffee shops operate. So somebody, let's say, buy a coffee shop or leases a premises and spends $500,000 to actually set up this business the way they want it. And what happens is, after spending $500,000 on it, that business makes very little money or just starts to breaking even, and they try to exit and they try to sell it for what they put in it. And the problem is that business is way overcapitalized, so you will not get it. The moment you open the doors of the business, the main driver of the value is profitability of that business. Similar thing happens with a lot of franchises. Big problem with overcapitalization is in import and distribution businesses. And we got something that we're looking at the moment that makes about $2 million a year profit. And I'll get into pricing a little bit more later on. But the problem with this business is it's got a $6 million worth of stock. So inventory is $6 million. So whatever you pay for that business, you'll have to buy this $6 million inventory. So let's, for argument's sake, and this is not a correct valuation, but let's say that somebody offers $8 million for this business. And if they have to buy another $6 million worth of stock, well, that's a $14 million investment, and it's very overcapitalized. So what they actually do, they value the business as a total enterprise value, and they take the working capital, inventory, and everything else out of it. So the actual price for this business is going to be $2 million plus inventory. And not understanding principle of markets and buyers, it's one big reason why people overprice the businesses. Now, just going to touch, I'm not going to read any slides except this one. So what's a fair market value? So it's a price that would be negotiated on the open market with a on open and unrestricted market between knowledgeable, willing, but not anxious buyer and knowledgeable, willing, and non-action seller on arm's length transactions. So what it means, the buyer understands everything. There's no pressure for them to buy the business. They want to buy the business, but there's no pressure. There's no pressure to sell the business from the seller's point of view, which often there is. And it's an arm's length transaction. So I'm not selling to my manager or my brother or my father or my mother, no one. So it's arm's length transaction. It's really important to know that. So in street terms, this would mean, well, if you put a business on the market, somebody walking off the street, what would they pay for your business? Now, there's another thing, which is synergistic value. And that's a concept that the combined value of two is larger than those two values, than the sum of those two values. So often, businesses will buy other businesses in order to expand their geographical reach, to expand their market share. But that's a synergistic value. Now, these are the drivers of the synergistic value. Economy of scale. So, well, I've got a business, I've got a really good back end, but I need more clients. I'm going to buy more clients. So my cost per transaction goes down. Entering new markets, acquiring new products, expanding market share, eliminating competition, increasing prices, and so on and so on. The reason why this needs to be mentioned, because people often say, well, there's somebody that's going to pay more for their business because it works more to them. But the reality is not that many people. You may going to be one of those very rare, I'd put that in 1% category, people that's going to have 2 or 3 people within industry competing for their business. Normally, there's only one. And that person will only pay $1 more than the buyer next to him. So if you got somebody on open market valuing a business $1 million, just the fact that it was $2 million to me, I'm not going to pay $2 million because, as a buyer, I'm not full. So I'm just going to pay a little bit more than what I think that the open market's going to pay for it. I'm just going to make one note here. This normally happens when you're not selling a business. So when you can sell business for more the market value, but it's only if somebody approaches you. So you're not on the market. The moment you go on the market, well, you're on the market, and market drives the price. So what happens when you go on what happens when you overprice the business? And this very important slide. So on the bottom line, you got the time on the market. On the left is a price. So here we got the price. Here we got the time on the market. This is a fair market value. And what's the common way of people putting on the market? They on average overprice it by about 70%, but it's not uncommon to see it double the price when you go on the market. So if you're the buyer and you don't just go on the market and buy a first business that you see, you're going to probably spend about 6-7 months looking, getting understanding on the market, looking at the businesses, missing out on some deals. And that is similar, like everybody can relate to this. If you bought let's say, commercial property, or when you bought your home or leased a commercial property or rented a house, it's exactly the same. You go on the market, you're looking what's happening, and that process on the markets actually educate you. After a certain period of time, depending, business is normally about 6 months, you actually know the market very well. You know what's selling, you know what's not selling, you know businesses that you looked at and how much they sold for. So if you look at a business, the market price is here, let's just call it $1 million, just for ease of calculation, and it's on the market for $1.7 million, chances are you're going to walk away from the deal. And most of the buyers won't, because the gap is way too big. And people won't give you, buyers won't give you an offer for two reasons. One is they think that you're not realistic, and second, they just don't want to insult you. If you're selling something for $2 million, that's worth $1 million. Like, what's the point giving a $1 million offer? We're too far apart. So what happens after that? Initial numbers of the initial wave of the buyers comes pretty much within weeks after you go to the market. And I'm talking here anywhere between 3 to 9 weeks. Similar happens if you're looking to buy a house. When the good house in your price range comes and you're a serious buyer, you got your finances in order, you're going to be the first person there to put with your best foot forward. Same happens with the businesses. Because you're overpriced, you're losing a lot of buyers. So after that initial wave of the buyers, you go, well, nothing happened. What are we going to do? Well, let's start dropping a price. We start dropping a price. Finally, 9 to 12 months later, we hit the market value. And what happens now is people that come and look at the business, they know that you've been on the market for 9 months and 1 year, and what they're thinking, well, what's wrong with the business? Well, there was nothing wrong with the business. You just overpriced it to start with. And then you are forced to put the price below the market value in order to achieve this sell. And unfortunately, this happens, this 4-point process happens in about 80% of the businesses out there. So how do you counteract this? Well, you need to price this business no more than 15% over the market value. Now, even if I know that that your business is a little bit more overpriced over the market value, chances are going to pay a little bit premium, because I was on the market as a buyer already for let's say a year. I found a business that fits my criteria. I want to move in. I know it's a little bit overpriced, but I don't want to wait another year, because the businesses don't come on the market on a weekly basis. So I go with my best foot forward, and I pay the market value a little bit over. Now, I've been doing this for 15 years. I can tell you probably 2 or 3 times in 15 years, and we dealt with thousands of businesses, that I have seen the businesses sell for way over the market price, more than 15%. There was an instance of IT business that got sold for $7 million. It was probably worth about $3 million, but it was a Japanese company that was getting into the market that they purchased them. And maybe another 2 or 3 deals like this. So chances of you achieving this astronomical price over the market value are probably less than 1%. But I can also tell you that if you overprice your business, chances of you going below the market value are about 90%. So gambling for this 1% versus 90% chance, I don't think it makes any sense. So the risk is really, really huge, and it's very important to price it right. Now, this is how it works. This is just a normal population curve. So in the middle, you've got a willing buyer and willing seller, and majority of the business sell here. There are a small number of businesses that sell for this synergistic value that I just explained, and some of the businesses sell below the market value, because whatever caused you to sell the business at the beginning, now it's more pressing to the time, and you're forced to price just to exit. The best way to secure that you actually reach this fair market value is to price the business right. So I'm going to explain to you how the pricing works. Now, if I deliver this presentation well, you'll be able to go to your offices, to your homes, to your computers, pull up some information and get some sort of idea of the value of your business on the end. You'll be able to calculate this yourself. Certain things that I'm going to tell you may going to come as a surprise, and some are going to be rude shock, some are going to be positive shock. But I'll tell you everything what you need to know. I'm not telling you anything you want to hear. I'm telling you what you need to know, hopefully. So, and it's really, really important to be realistic on this. There are three components to pricing a business. One is a profit, obviously, but there are different types of profits, and we're going to get into it. The other one is a market, how buoyant market for certain businesses in certain given time. For example, if you got anything to do with camping industry, camping manufacturers, camping equipment importers, or you got a caravan park, the prices are just absolutely through the roof. Well, they're not through the roof, but they're higher than before the COVID, because we can't travel. So the caravan parks are operating 100% capacity, and that's here to stay for quite some time. And the last one is the risk, and risk got a big impact on the business. And we're going to get into each of these components. So risk, meaning when you buy the business, what's the likelihood of this profit that you purchased declining going forward? So let's look at the profit first. So we look at the past to determine what the future holds. So it's, you got to look at the best way is to put your 3 years of P&L, print them out, put them next to each other, and analyze this a little bit first. Have a look at what your GP, what your cost of goods are, line of expenses. Are there any expenses that 1 year they're up, they're down? Are there any missing expenses, one-off expenses for profitability? And adjust this for this normalized trading. If the fluctuation of your turnover or profit or gross profit or whatever it is, it's fluctuating, it could be normal way of the business, like in this case in the contracting. Understand why is that happening. And it's, you really should examine minimum of 3 years. Further than that, going back further than 3 years doesn't make sense, because your business is probably different now to what it was 3 years ago. Looking at 1 year also doesn't make sense, because it doesn't tell you full picture of the business. So once when you do that, you need to adjust these financials. So businesses are sold on PBTA or EBITDA, and I'll get into this as well in a second. But it means all the benefits, excluding all the paper expenses, that's what the buyers are looking for. So what you add back into your profit, and if you're looking at your tax return is not a true representation of your business. Tax return is a document that you provide to the tax department for assessment of your tax position. So you got to add back to depreciation, amortization, and interest paid, one-off expenses, any owners' personal vehicles, family phone numbers, family phone expenses, which are plentiful in any private business. Owner's wage, owner's superannuation, life insurance, anything that's connected to you as the owner of the business. Any owner's discretionary expenses, such as travel, private expenses, but only if you got a proof and you can actually demonstrate this to the buyer that that's the case. Also, you need to adjust. So these add-backs are pretty much putting expenses back into the profit. Adjustments are, taking putting expenses back, taking them off the profit. So rent, if you own your own premises, make sure it's a commercial rent. Adjust for owner's market wage, because often the owners of the businesses, myself included, will pay ourselves what it gives us the best taxable outcome. So you may gonna overpay or underpay, but you need the owner's fair market wage. Expenses, they are out of the ordinary. So lately, all these expenses, they were incurred due to the COVID, and in some businesses there was a lot of cleaning and a lot of issues and a lot of spending to put infrastructure to work from home. Well, they should be really adjusted and put back into the profit, because it's out of the ordinary expense. On the other hand, we really need to adjust for the profit for any one-off income, such as JobKeeper or any other government subsidies. So I hope this is a little bit more technical, and I'll try for this to be the last technical part. But it's really important to adjust this to actually see where your business sits and to understand it. Now, owner's wages, I just wanted, there's a difference between drawings and salary. All right, drawings, you can take them any way you want to take them. The salary is what you should pay somebody to replace you to do your job, and it needs to be market salary. Now, when adjusting for your market salary, position of the owner in the business. So what do you do? Hours of the owner, how much do you as the owner actually work in the business, and make sure it's not understated. We all say, I work only 20 hours, like, but in reality, it's 55. That's for weekly hours. Geographical position of the business. So we used to use about $100,000 for the owner manager for the small to medium business in Sydney. You can't do that. People laugh at you. Like, you can't get a manager to manage a business, especially if the turnover is about 5-6 million for 100,000. But what happens somewhere in the country or Stradbroke Island or somewhere, $100,000 for the general manager is a good pay. So geographically, you got to take in consideration where your business is located in Australia. For the owner manager, size of the business as well. So, if you're just operating a little signage shop that turns over 500,000, well, the owner manager is going to less as opposed to import-export business that's turning over $20 million. For business under management, if you've got a business under management and you're valuing this yourself, be realistic on how many hours and what you actually do for the business, because often people say, look, it's 100% under management, but they make every single decision in the business through a day, just over the phone or email. Now, once when you've done all this and you've got some idea where your profit is, you have to decide, what do you use? Do you use the average profit, or do you use a last year profit? And I've got an example of 4 businesses. One is making 100,000 profit each year. One is making 50, 100, 150, which means going up. One is making 150, 100 and going down. Last year is 50, and one goes up and down. So if you look at it, this first business, there was 100,000. It's over the last 3 years, it's very consistent. It makes 100 grand. Well, in this case, it doesn't matter what if you take the average year, you take a last year, it's going to be the same. Now, businesses, which is this number 3 that's going down, in almost every case, the buyer will look at the last year because the business is declining. So taking averages here, it's not going to do you any favor unless there's a reason why the business was going down and it's reasonably expected to bounce back because you won the new contracts and they're in place. Similarly, with this businesses, and this is the best case scenario, when you got a business that's going up over the 3 years, it's safe to take a last year. You wouldn't take averages here, especially if it's repeat business that the business generates. Now, if you've got a business like this, which is often the case with any contracting business, so where you're putting a large invoices, and it depends what time of the year you invoice, especially when the financial year changes, you have to take the averages in order to work on the profit. So by now, we know what the profit is and what profit we're working with. Now we need to calculate the multiplier. So, and look, there's about 50 different ways, valuation methods, but this is how the buyers are looking at the business. And what I'm about to show you, it's how the businesses sell on the market, what really happens in the real life there. Now, before I get into this, let me explain to you why people pay certain multipliers for the business. So I've got a little illustration here of investment options. So on the left-hand side in green here, you've got a low risk. On the right-hand side, you've got a high risk. And we're going to display return on investment for each of these options and what that represents in multipliers. So if you look at the government bonds at the moment, I mean, some are 2%, but they are generally less than 5%. That's a multiplier of 20 times, which means if I put $100,000 in government bonds, I'm quite happy to get 5% back because it's a very, very safe investment. And that comes to that of the what we talked about, and which I'm going to get into more detail on that risk component of the business. Now, Second one, he is a property, and I'm not talking about residential property because that doesn't make sense to anybody at the moment. I'm talking about the commercial property. So commercial property, normally people with a capital gain and return on investment, gross rent, they're looking for return of say 6 to 10%, depending where the property is located. That's about 10 to 14%, 10 to 14 times multiplier. Next one is share market. It's been booming at the moment, but so people looking somewhere 10 to 17% long-term return on the share market, which represents 6 to 10 times multiplier. Now, on the other hand, we got a speculative investments, Bitcoin or whatever you want, and this is where I want to put the money. I want to get my money in 1 year. So it's a very, very speculative. You're looking about 1 times, all right, or less. Otherwise, I mean, it's not a safe investment, but I'll go that way. I'm going to put a small amount of money from my portfolio just to see, let's speculate. So the businesses fit somewhere between share and speculation. And that's why they sell between 1 times and 5 times that profit that we talked about. And I'll explain to you, I mean, it's a big range. If you have a business that's making 100,000, if you multiply by 1, it's 100,000. If you multiply it by 5, it's 500,000. So the range is huge, but it's a little bit more precise. We're going to get into detail of it. Why not more than 5 times? Because if I can get investment more than 5 times, I'm starting to get in this region, and then I'd rather go and buy the commercial property because that's another thing. All these 3 investments on this side are passive investments. I put the money and I don't have to worry. It's managed by professionals or it doesn't need management. Now, another point I have to introduce here is EBITDA and EBITDA. All right, so EBITDA is a proprietor's earnings before interest, taxes, depreciation, and amortization, which means EBITDA is adjusted profit plus owner's wage. So that's EBITDA. So what I, as an owner, take from the business. So it's proprietor's earnings. EBITDA is after I take a market wage for the owner that gives me EBITDA. And if you use these wrongly, and it's a very, very big mistake, especially by accountants, and I'll get onto that in the end, the biggest mistakes made when valuing a business. The error can be huge. So if I got a business that's making 200,000 EBITDA, which means for me as the owner pulls 200, I multiply this by 3, I get 600 valuation. If I take my wage and let's call it for ease of calculation, 100,000 out of it, business makes 100,000 only, I multiply that by 3, the value is 300. So the difference is 100%. Here's how we came up with this model over the years and simplified as much as we could. And this will give you idea how to, I just got to move these little people from here. This gives you, we came up with this exclusive valuation pyramid, triangle, call whatever you want, but there are 3 segments of the market. This is the size of the market. So businesses with EBITDA less than 50, so EBITDA, so profit after the owner's wage, which is less than 50% of the market wage of the owner, fit in this blue category, and they're the largest segment of the market in Australia. So what I'm saying here, if the business makes $150,000 for the owner operator, and owner's market wage should be 100,000, that gives you 50,000 EBITDA, which is less than 50% of the fair market value, or over and above fair market wage, over and above owner's wage. They fit in these, and we call this blue zone here, we call these job type businesses. That's when I buy the business and I bought myself a job. I have to work in the business. It's not by no means passive investment. It's highly reliable, reliant on owner, and only gives me 50% more than what I would get to actually go and get a job. And they sell for 1 times EBITDA. So if the owner operator can make $150,000 in the business, in most cases, that business will sell for about $150,000, no more than that. And the reason for that is I can go and get a job and get 100,000 and keep my 150 and then invest that into whatever else I want to invest. And that's why, and that's from the market experience. That's what's really happening out there and actually makes sense from the buyer's point of view. Next is this green zone, which is businesses, they make more than this. So they're starting to make $100,000, $200,000, $300,000 profit after the owner wage, and goes to about 1.5 million at the moment. And they sell on about 3 times EBITDA. They can go lower than that or a little bit higher than that, but most of the deals are about 3 times. This green zone we call profitable type businesses. Once when the business starts making profit after the owner's wages, over $1.5 million, they get into this orange part of which sells on about 3 times, more than 3 times EBITDA, sometimes up to 5 times, and we call this substantial businesses. And this is how the market looks like. Most of the market in Australia, these small businesses. Then there are these green ones that making some around 300-400 to about 1.5 million. And then if you got a business that's starting to make more than $1.5 million, providing that the risks and everything else are there, they sell for over 3 times. So I hope now value of the business is total value of assets, inventory, and working capital. So it's not, and remember when I was talking about capitalization, over capitalizing business early. So the buyer is looking at the total investment for them. So it's not you're making $1 million, going to give you $3 million, and then I'm going to buy plus $1 million worth of inventory or stock. Then the purchase price is $4 million, which means my return on investments that I'm hoping to get around 30, it's now pushing towards 20 or 15%. And there are better businesses out there. Just think about it, all right? If you can buy the business that makes $1 million and you can buy it for $3 million and it's got no stock, and then next to it, you got a business that makes $1 million, they're asking $3 million, but you're buying another $1 million worth of stock, you're paying $4 million. Why would you when you can buy this $3 million and keep your $1 million? So it's a total enterprise value. So keep that in mind. So if you're calculating based on this formula that I just explained, and you come up to the value of $1 million, but you have a 300 grand worth of stock, you will probably achieve the price, whatever your calculation, let's say it's $1 million, you'll have to take this $300,000 off it. And that's what's going to be final price for the business. So a lot of people got a bit of and a lot of accountants do have a little bit of issue actually getting this concept, but that's what actually happens on the open market. So market, what's a business market? Well, when you are valuing a business, and that's really hard to do to somebody who's not selling a businesses all the time, but like you can make some sort of assessment. How good is demand for this business? High, moderate, and low. Like anything in retail, unfortunately, it's very, very tough to sell at the moment, for obvious reasons, because of the COVID, because of the changes, because of the online. Anything that's online, it's huge demand for it, for the same reason. So you got to ask yourself, well, where am I sitting at the moment in industry and all the changes that's happening? Where's my business sitting? Before you decide if it's high, moderate, or low. And also, where do I sit geographically? Can my business run from anywhere in Australia because it's online? Well, anybody in Australia is your client. So your market is much larger. The larger the competition is larger. But if you got a business, and I'm not going to pick any places, but if you got a business that's remote, well, there's going to be less buyers. So you got to adjust the price for the fact that you're not in highly populated area. Now, risk. So risk of the business. So everything I talked about now, it's very easily to actually determine and calculate. The risk is more intangible. Like we can calculate the profit, we can figure out, but where does the risk sit with us? And the risk got a big impact on business value. There are ways that you can offset that risk through certain mechanisms, but nevertheless, it will have to be addressed. So these are main risks. I mean, it could be anything, but too big exposure to small number of clients. So if you got a business that's got one client, obviously it's going to be more risky business than same type of business has got 100 clients. Why? Because if you lost that client, you lost the business. High reliance on skills and expertise of the owner. If you really have to run this business all the time, it's going to be much harder for you to find somebody. And look, the sellers always try to play that down, but we are in the process of valuing a business that does design for certain products. And for 15 years, the owner was a head designer. And to find somebody that's creative as he is, it's really, really hard. You can find a draftsman who's going to, make drawings and everything else, but somebody who's going to come with ideas is going to be much harder. So the risk is very risk in that business. In this example, it's going to have a much bigger impact on the business value. How reliance on the key employees? I don't have self-explanatory. Good example is a chef in the restaurant. Complete reliance on one supplier. This is very common, especially with importing. Most of the importing contracts, especially from the larger companies, are reviewed every year. So, and that represents a risk from the buyer's point of view, because your business could be very, very profitable at the moment, but the moment somebody buys it, the contract gets cancelled and they bought nothing. And it does represent a risk. We can go into later on into more detail how to actually offset that, but it is a risk. Uncertain tenancy, and that's not just for the retail businesses, like because you're month by month or whatever, but for manufacturing, and more manufacturing we're seeing now transacting on the market, because manufacturing business is very expensive to relocate. And it could be, depending what equipment and what machinery they got in it, it could be in hundreds of thousands of dollars. And it's not like you move your house in one day. Sometimes it takes 3-4 months, and there's an interruption to the business and everything else. And uncertain cash flow, that's a big one, because it goes up and down. Very, very obvious with the contracting businesses. These are the value drivers. Well, it's opposite to what I just said. Little reliance on the owner for day-to-day operation and management. That's very desirable. Market leader in the industry, so your size, or it doesn't have to be size, but maybe operation in each industry, it gives you advantage, it gives you security. Desirable location in the industry. So depending where you are, obviously in the major centers, but now what we're seeing, certain parts of Queensland are getting very, very desirable because people are moving there. Good diversification of products and services. So don't depend on one product or one service. Businesses under management always helps. Flexible working hours for the owners, very, very desirable with all this online stuff. Could be run from anywhere. Another thing, and more businesses we're seeing that actually can be run from anywhere. And due to the COVID, that actually we think it pushed everything about 10 years ahead, because working from home wasn't as acceptable. But doing this Zoom, and we're doing a conference at the moment, and everybody's sitting at home, and it's very acceptable. If we tried to do this 5, 6, 10 years ago, it wouldn't be seen as valuable as it is now. Excellent sales marketing system and team in place. Now, your sales team and sales marketing systems are very important, because in a lot of businesses, the head of the sale is the owner. And anybody who tried to find a good salesperson and went through a recruitment system, he knows it's it's easy to find a salesperson, but to find a good salesperson, and it's not that easy. So a lot of buyers will have a technical knowledge, but they're not good salespeople. So they will price the businesses where they have to sell much less than where they don't have to sell. So if you got a good sales systems and good marketing, that just, leads come in and somebody converts them and then goes in production, that's a big value driver for the businesses. Now I'm going to touch on the assets. Again, businesses are not business plus the assets, but you have to consider them. And often, in some instances, such as like transport business, for example. You could have a $1 million profit, but $5 million, $10 million worth of assets. So where the difference between a formula that I showed to calculate the businesses and the asset value of the businesses is great in terms of assets are way more expensive than the valuation of the business based on profitability. Those businesses sell for the value of the assets, maybe a few bucks on top of that. But it's very important to understand how the assets are valued. So it's not a book value. Book value is depreciated value. It's done there by statutory depreciation numbers, which means tax department tells you, all right, well, you can, for this vehicle or for this piece of equipment, you can depreciate 20% a year. All right. Now, there's another value that's called as-is value, and what does that even mean? All right, as-is value. So I'll go back to this in a second. Insurance value, it's not a value. Often people say, well, I got an insurance value of $3 million on my fleet. Well, that's insurance value, but that doesn't mean that that's a fair market value that you can sell that equipment for this money. Owner's valuations, it's always high. That's stuff that you put on the paper and you say, okay, I think this is it. And recreation value, that's how much it would cost me to recreate this. Let's say at the beginning of this little talk, I talked about a coffee shop and I said, look, it costs $500,000 to make it. Well, that's the recreation value. If you were to do what I've done, it would take you $500,000, but it doesn't mean that it's worth $500,000. So I'm going to go back to this as-is value. As-is value, it's kind of combination on all of this. So as-is value could be like, I've got a second-hand equipment because it's not new now anymore. Like I had it for 2 or 3 years, so it's pre-loved. So how much can I buy this equipment on the open market in the same kind of state? And then I have to bring that equipment and install it in that business. And what's the cost of this? So when I'm buying as-is, when I'm calculating what would it cost me to rebuild the business with this type of equipment in the same shape and place, I'm adding installation value. But when I'm selling as-is, the equipment goes down because whoever buys this from me, they will have to install. So you got to take installation value off it. What the buyers look at is a liquidation realizable value and orderly realizable value. So, which means, and the reason why they're looking at this, because the banks are looking at this. So if I've got an equipment that the bank thinks they can sell for $1 million if need be, either in liquidation or orderly resale. Like difference between liquidation and orderly sale is liquidation, I put it out there, best offer takes it. Orderly, I manage the process, but there's a cost in orderly value because in orderly sales, because you can't do it overnight. So that's what the buyers are looking for. So they're saying, all right, well, you got a business and you want $3 million for the business, and this business got certain level of assets in it. If everything goes pear-shaped, how much can I realize? What's my risk going into the business? Also, what they're looking at is, can I borrow money against some of these assets, which will give me better return on equity? Inventory, which is stock. So, and I touched on that. So if the stock value is 10 to 20% higher than the value of the calculation that we've done, well, you can sell off a business on the market for value plus stock. But if it's more than that, it has to be adjusted for that. Another thing about the stock value, it's often source of argument between buyers and the sellers when we're doing a deal, because what's a stock? Normally, anything 12 months old is a good stock, but anything that you got 3 or 4 years there, and most of the businesses that operate for a long time, they accumulate some. It still has some sort of value, but definitely not 100%. So sometimes they get discounted to about 10%. So when you're looking at your stock, calculate it properly. Now, working capital is a big one, all right? So working capital in the business, again, I'm talking about sale of the business as a total enterprise value. So if I calculated my business that makes $1 million, will sell for $3 million, and it has only $100,000 worth of stock, well, I can add this stock for the moment. But if that business needs $1 million to operate, And that could be because I'm buying my goods from overseas and I'm paying cash before they get sent to me. And then I'm selling those goods on 60-day credit. Well, before I start getting any money, it's gonna be it's gonna be 60 days, and sometimes they can be $1 million. So that has to be factored into the price. So working capital, again, if it's 10 to 20% of the total sales value, you don't really have to spend so much time on it. But if your receivables are if you got a business that's making $1 million, but your receivables are constantly in $1.5, $2 million, and your payables are only 500,000, well, you really need to consider it. So normally the offers will come based on that calculation that I show you: less working capital, less inventory. Now, I'm just going to finish with this, and I don't know how we're going for the time. I think we're doing all right. These are most common mistakes made in when people valuing the businesses. Failure to interview management. So a lot of accountants are doing that. So you're going to go to your accountant and you're going to say, look, can you give me a valuation on this? And they're going to say, yeah, no problem. And they're going to look at your P&L, they're going to look at your balance sheet, and they're going to do some sort of calculation. And they'll say, hey, this is the value of your business. But without interviewing the management, without inspecting the business, without really understanding a business, and that for the owner, it's not a problem because you know it inside out, but from somebody from the outside, it's impossible to assess the level of the risk and complexity and value drivers. So it's not just the numbers. In fact, that non-financial part of the business, it's probably bigger driver of the value of the business than your pure profitability. And I can tell you, I have seen businesses that are extremely profitable, which were really hard to sell for the top market value because of the risk that they were associated. Relies on historical earnings and use of average profit. So I explained to you when to take 1 year, last year when to take the averages. And what I see a lot on the market out there, they always take the averages and say, well, should be average, regardless if it's going up, down, sideways, all right? Then what they do on top of that, they have this leap of faith. They said, okay, this business should sell for 4 times. And without any comparison, why it's 4 times, why it's not 3 times. So that leap of faith of cap rate. One that I didn't put here, but should be talked about, is using a wrong base, which is that PBITA versus EBITDA. So if you got a business that's making 300,000 for the owner operator, and you multiply that by 3, I'm doing quick calculation, that's 900,000. If you take the owner's wage out of it and you call it 100, it's going to give you 200 times 3, that's a 600. So if I don't look at a proper base, I'm actually making 30% error in this. Managers' wages are often not adjusted properly, and that's never up, it's always down. We always look at the managers' wages conservatively, and we say, well, not conservative, opposite, because we underestimate what would cost a good manager to actually run any business. People often use a lot of rules of thumbs. These businesses, they'll, take a childcare center, for example, if they can put a little 40 kids in there, well, so much per kid, but you can't do that. That's fraught with danger. And why? Because let's say we got a business, we got two childcare centers relatively close to each other in the same area, and they both having a center for kids and everything else. But one's got a $200,000 rent a year, the other one's got 100. Well, 100 is going to make 100 grand more, and that's why you can't use those rules of thumb. If you ever heard in your industry something sells for so much for this, it's best to ignore it and actually do the proper valuation in your business. No allowance for working capital and stock. That's a big one. And the biggest one by far, done especially by the accountants, by the owners as well, is this thing when they're calculating goodwill and they say, okay, I'm making 300, my goodwill is plus another times 3, that's going to give me 900, plus my assets of 500, plus my stock of 300. And all of a sudden, this just builds up and builds up and builds up, and it's a double dipping. It's actually not possible to calculate a goodwill. So accounting term for goodwill is value of the business less the value of the assets. That's how. So you have to calculate the business, deduct the value of the physical assets, whatever it's left, it's goodwill. Goodwill is not possible to calculate by itself. Another problem with this word goodwill is that it's used in few different contexts. So, for example, accounting goodwill and what people in a business talk about a goodwill, which is power of business to attract the customers, they're not the same things. All right. So adds this extra confusion. And it's a common mistake. All right. So because of everything that I was talking today, if you don't price your business correctly and you decide to sell it tomorrow and you price it too high, chances are you're gonna sell it for below the market value. But if you're not thinking about selling business anytime in the future, but you're thinking of obviously building your business, keep this in mind, because these, especially this capitalization and spending too much money, just, I'm not saying, look, walk away from the big client because it's not going to go improve the value, but just understand it's not the same thing. So as you going towards your exit, whenever that's going to be, if ever you may going to pass it on to the family or whatever it is, just every decision that you make for expansion of your business, ask yourself, well, now I know a little bit more about the value. How's it going to affect my value? All right. And there could be not just investment in the capital assets, but it could be investment in people. Am I giving too much power to one of the employee? Is the business relying too much on me? Am I having too many family members in the business? But when we say we're all going to leave and we're all going to take all know-how and IP with us. So just keep that in mind. And I hope you got something out of this. Look, it was a lot of stuff to put in very short period of time. So if we got the time or a way to ask the questions, we can ask the questions. Otherwise, I gave you as much as I could in this short period of time about the business valuations.